cost versus rate. So this is actually going to be a perfect segue because the topic we're going to talk about today, we were just reapproved to submit SBA 7A loans or SBA Express loans. Most lenders got away from the SBA Express programs with the advent of COVID because obviously businesses looking for the payroll protection loans where they're going to get all the money forgiven, basically a gigantic government grant. Are they really going to want to make payments and pay interest when they have free money staring them in the face? So most banks switched over to focusing on the PPP loans because it just made more financial sense. You know, in fact, every business who can should apply for it financially for themselves. With that being said, now as the PPP loans are being facilitated and a lot of businesses have already secured them, now what's happening is people are looking for additional cash. Obviously, ideally for us, will be clients who are looking for SBA loans as well as working capital loans. Those are the two primary products that we offer in addition to equipment financing. And so understanding the SBA product is immensely valuable for us because it will give us the opportunity to essentially offer an array of services to our clients. And we're not just being a one-trick pony at that point, right? We're offering them an SBA loan. We're offering them a line of credit. We're offering them a working capital loan, equipment leasing. It's very hard for a client to say no to you. If you're offering them 4 different products, they're probably going to want one of them, right? The SBA loans are very traditional, have very traditional types of terms, right, that customers will be more familiar with and more likely to proceed with. Working capital is going to be more useful for people who just need money fast, right? So remember yesterday, we talked about the idea and the concept of cost versus rate, right? So I want to kind of briefly recap on that before we go too much into the next segment. So with that being said, what's the difference between cost versus rate? Somebody.
Time.
Who's at time? Well, time definitely plays a factor in cost versus rate because the rate accumulates over time, right? So for example, if you take a mortgage out at 4%, a lot of clients naively think, oh, I'm going to pay only 4%, right? Well, that's not remotely true. You know, on a 30-year mortgage, you borrow money at 4%, borrow 100 grand, you're going to pay back about 200,000, right? So you paid 2.0 for those of you that are familiar with factor rates, right? Now, obviously, it's a much longer term, monthly payments, whatever. So with the SBA programs, they're going to show a lower interest rate, right? Keep that in mind. It's going to show a lower interest rate than working capital. Working capital, if you annualize it, you could be looking at credit card type rates. It can be expensive, right? So with that being said, though, is if the customer complains about the cost, what you really want to do is you want to separate the two concepts in their mind, right? Because a traditional financing option, like a mortgage or a term loan, actually costs more money than working capital. The cost is greater, right? Not to be confused with the rate, right? Because think about it. If you're paying a 10% loan over 5 years, like let's say a typical equipment financing deal, 9 to 12% over 5 years, you're actually going to pay a little bit more money on that than you would pay on a short-term working capital deal, right? And like you said, Tony, it's particularly because of the time factor right there, right? So one of the downsides of the SBA products and any long-term amortizing loan product is going to be that despite the low rate, there is a higher overall cost over time. Does that make sense, everybody? Okay, so with that being said, let's talk about, once again, we're going to recap it much more quickly than yesterday, is we're going to talk about the pros and the cons of long-term versus short-term, and then we're going to talk about what a long-term deal looks like and what documents we need to submit that. So, what would be, let's go ahead and go with the long-term, and then let's go ahead and go with the short-term. Right? So, on a long-term product, what are some of the advantages of it?
More funds, larger approvals.
Okay, so you can typically get more funding. Why can you get more funding on a longer-term product?
Because
what?
the payments are smaller, so you can afford more, like over the long term.
So what you're saying is because it's a longer term and you're stretching the payments out over a longer period of time, with a lower payment, you can afford a larger financed amount. That's exactly right. Right? And by the way, the reason I'm teaching it to you guys in this manner is because it's important to constantly educate your clients. If your client is going, I want the lowest cost, they might actually mean I want the lowest rate. right? And that's a very important distinction. You wanna go, well, Mr. Customer, what do you mean? Do you mean you want the lowest overall cost? Or do you want the lowest annual interest rate? There's a big difference there, right? And if you have that conversation with the customer, they're gonna understand, wow, this person's actually a professional who's educating me properly, rather than somebody who's just like, well, you want a lower cost? Well, here, right? So what's up, you got a question?
It's so hard to avoid people that are like just arguing with you, you know, like how do you make something, when you tell them something, you know, they feel like it's just an argument. You get what I'm saying?
Well, I mean, I would probably say that tone is probably one of the most likely factors in that. If you speak with a certain tone, you're going to derive more arguments than a rep who says things differently. I would say use tact. You know, for example, saying something like, well, no, Mr. Customer, the way it works is this. Well, when somebody hears no, you're already at the beginning stages of an argument, right? Whereas if you go, well, the way I've always looked at it was like this. You can relay the same information in a much more palatable way, and a much less combative way, if that makes sense, right? And so that just takes time. With sales experience, you'll learn to say sensitive things in a way that doesn't conclude in an argument, right? So with that being said, what are some other pros of long-term financing?
Huh? Pros? Oh, more?
Yeah, what are some of the advantages of a long-term program, like an
Low
SBA
rate.
loan or a quick
Low
lease?
rate, yeah.
Yeah, okay, typically there's gonna be a low rate, right? And as you know, as you call customers, what's the first question they typically ask you?
What's the
rate?
interest?
What's the rate, right? What's the rate? What's the rate? What's a good answer to that?
My VP of Finance will talk to you about the cost of funds.
Depends on a few
What's
factors.
the rate? It
We have a couple
depends.
different products we can get you into. Each one of them comes with different rates and different terms. I'd be happy to delve deeper into that. What exactly is it you guys are looking for?
That's exactly right, is think about it. And this is not a shady sales tactic. This is just us being completely humble and honest with the customer, right? Is, if you think about it, we don't know the rate they're gonna get. We don't have a magic wand that dictates, oh, Mr. Customer, you're gonna get 3.75 today, and you're gonna get 17.5 in a week, right? Nobody knows that information. If any sales rep is giving that information to a customer on the first call, they're lying. So if a customer thinks that they're being hip to the game and thinks they're being smart and shopping around, but they're spitting numbers out, that is a deceptive, lying person that you should not trust, right? That's why you do not give rates out on the first call. You might be able to remember, you guys have a product sheet that kind of has a little bit of a range, kind of a best case scenario to worst case scenario type of thing. If they really hound you and demand you for it, you could probably give them a range and they're gonna go, well, that's very broad. And you go, exactly, I haven't seen your file, I don't know your credit, I don't know what your bank statements look like, I don't know if you're profitable, I don't know if you need the money tomorrow or if you need it next month. There's a lot of steps involved in here so we can set you up with the appropriate program. It would be irresponsible for me to spit a number out to you in an effort to earn your business. If anybody does that, sir, you should not trust them. Does that make sense? That would probably be a good way to say that. You might be able to, there's a great book called The Challenger Sale, where it talks about, if they kind of get like that with you, to challenge their ideas, but not argue, Oscar. Try not to argue. So it's a fine line to walk down, right? Yeah, Oscar, and Don.
I sit next to
Don's
Don.
king arguing. So anyway,
Thank
what
you,
is this?
Zach.
What is this? What is this? Big label. What is this? What's another advantage of the long-term product?
It's long term.
Well, it's a long-term, but what does that imply?
Oh, lower payment.
A lower payment.
Shebang.
Right? A lower payment.
Don, you know that.
Yeah.
A lower payment will oftentimes be what clenches the deal. Sometimes customers need working capital, but they're willing to wait a little bit of time. They might be able to wait 4 or 5 weeks, and they frankly can't afford the payment on $100,000 over 8 months or 12 months, right? And the working capital product, you know, like merchant cash advance, whatever, that's not gonna be the best fit for them, right? SBA might be. Now, of course, if they need funding sooner, then obviously we're gonna have to go with the short-term product because it's faster, which leads me into this. What are the major downsides of long-term programs?
You're hanging on to it for years at a time.
So, which results in what?
A higher cost at the end of the day.
That's exactly right,
Yeah.
is they cost more. And it's funny, when you say this to customers, they go, blasphemy. Even when you say it to people in this industry, they go, this is blasphemy, that makes no sense. I have a lower rate, it can't cost more. I'm like, well, let's not look at things so simplistically, right? Is if you're paying an average SBA Express loan, you pay about 7.5% APR. I think right now it's actually between 7 and 8. with the advent of COVID and stuff.
Are those front loaded with interest?
They are indeed front-loaded with interest as well.
Okay, so
Most
it's the first 2 years.
amortizing loan products are front-loaded. We'll talk about that in a moment, that'll be another con. With that being said, is if you're paying 7% over a 10-year term, you could pretty easily do some math, right? I mean, obviously, the principal gets knocked down and everything, so you can't do the math exactly in your head.
Yeah,
But I
it's
can
like
tell you one thing, you're gonna
7%.
pay 30 to 50 points for that money. And people go, no, it's not 7%. I go, look at it on a spreadsheet, dude. Look at it on an amortization calculator, right? And then you can come back and talk to me. Because when a customer goes, well, if it's 7%, why would I pay your 12%? And I'll go, because my 12%, you're gonna be in and out, and that's your total overall cost. That 7% is going to apply to that remaining loan balance year after year after year. You're gonna pay double or triple on that loan. But it looks appealing to you because you see the low rate. It's a trap, it's a trick, it's a trap, it's an entrapment. It is a fugazi, right?
Don't we have to like convince them out of like traditional loans then? It's
I'm
like
not-
part of our
no,
sales,
no,
right?
no, now keep in mind, the purpose of this is to show them as earnestly as possible the advantages of each program. Because a lot of them will just shoot down the short term out of pure ignorance. They just don't know that the cost is not really very much different.
No, they hate weekly.
Yeah, well, we talked about weekly payments and so on and so forth and that.
That also, but I think obviously if they're looking to borrow a set amount of money and you're like, well, you can pay it back over 5 years, as opposed to 2, they go, well, I want that 5-year.
I want that
Flexibility and
what they
window.
want, is
Yeah.
they want that low payment.
Yeah.
Now, a lot of customers, the ones that think they understand finance and perhaps they're a seasoned negotiator, most of business owners are somewhat adept at negotiating, they're gonna think, oh, well, I'm so smart, I'll take the long-term program at 7% and then I'll just pay it off early. So that way the cost doesn't affect me as badly. What's the folly in that logic?
Because with any amortized loan product with front-loaded interest, that means there's no incentive to pay it down early, is that correct?
It's not that there's no incentive, there's definitely incentive to pay it off early.
it's
With
not
majority of the
incentive.
payments going
But
towards
when you
covering
try
the
paying
interest
it
on
off
the
early,
loan.
you're already paying double because the interest is front loaded.
So, not necessarily double, but think about this, like, people think, oh, it's let's say it's 7% interest rate loan, right? It's 7%, so if I pay it off after a year, borrowed 100,000, I'm only paying $7,000 of interest,
Yeah.
right? Completely wrong,
It is.
completely wrong. Because that 7% is weighted more heavily in the front, right? Here's the interest, here's the principal, right? So, with that being said, let's say it's a 5-year product, right? So we have kind of like year 1, year 2, 3, that close enough to 5, right? The point is that first year, you're not paying 7%. You're paying like
60.
20%.
Oh, shit.
And people go, no, it's only 7%. I go, dude, look, like this is how it works. Look at an amortization calculator. This will tell you. Is that first year, because remember, this is the customers who think, well, I'll take the 7% loan and I'll pay it off after a year, and that way I get the best of both worlds. I get the more money, the lower payment, but I also minimize my cost. And they're completely wrong. Is because by paying off in year 1 or year 2, you're probably paying, let's say, for argument's sake, it's 7% over 5 years, right? So whatever, let's just say for argument's sake, they're paying back a total of 128K or whatever, I'm not gonna say they're out of the number, so let's say that, right? So if they were to do this and they paid off here, they're gonna end up, this 28K, probably like, maybe up to here, is probably like 24 of it, right? So if they paid off early, and this might be 18, and this might be, 5, and this might be 2, or whatever the hell it works out to, right? So the point is, I know I did the math wrong, but that's not the point. The point is the philosophy here, right? Is that by them paying off early, they're not saving as much money as they think. And
Are
not
they
to mention,
saving any money? I mean-
well, they save a lot of money. They save all this. If they paid off year 1, then they save all this. So they might pay, 15, 20%, but remember, with long-term loan products, they also typically have higher origination fees. Almost every long-term product
Ooh.
has origination fees.
I didn't get that one yet.
Right? The short-term products also do have fees. Sometimes they don't, sometimes it's minimal, whatever. But on a long-term product, you're getting a much larger amount and a higher percentage fee. A double whammy. If you're getting, if you're getting twice the loan amount and double the origination fee, instead of maybe 2%, you're paying 4% on double the amount, it's literally like 4 times the fees that you pay, even if you pay it off early, now you get hit with the front loaded interest. This is why customers who push and push and push for, I want the lowest rate, I want the lowest rate. The best thing to do is educate them, because it's not their fault, they just don't know better. They only know one piece of finance. They know, oh, I should negotiate the rate. Yes, the rate is a factor in your overall cost. Yes, obviously it would be stupid to say it's not. But it's extremely foolish if they're so focused on the rate that they end up paying way more money to borrow the money. And that's just reality, right? It is not a trick, this is just facts, right? So with that being said, the cons is that the long-term products typically cost more if carried to term. They have higher origination fees. Keep in mind, this is just on average. I mean, obviously, if you look high and low for long enough and have your credit pulled a dozen times, and somehow you're still able to get approved after that, you might be able to find one guy who doesn't do it, right? But that's by far the exception, not the rule. You had a question, Oscar?
Go on.
Sure. So with that being said, is the other downside. So basically the main downsides are the cost more, origination fees. What's one of the biggest downsides for our average client?
Time to underwrite.
Time, baby, time. Is time. Now there are a couple lenders that can knock these types of programs out super quick. And are they gonna be cheap? No. They're gonna be those people that you might hear on the radio, whose names I'm not gonna say because we're recording this, but there's people that, names you might hear on the radio or television advertisements, that you're gonna get a call and they're gonna be like 128 APR. And you're gonna go, what the heck, I've never heard of numbers like that. We'll be like, yeah, we've seen that, because we compete with those guys.
I have some ideas of what type of names those are.
Yeah, well, we're recording this stuff. So the time to underwrite, typically speaking, most longer term products, everything from equipment leasing to SBA or regular equipment financing agreement to an SBA express loan, they're all gonna take drastically longer than most short-term products, right? So with that being said, is time is gonna be anywhere from best case, I'm gonna say, for a really smooth, easy piece of equipment, you might be able to get it done in 3 or 4 days. Has anybody ever done an equipment deal faster than that? It's okay if you have, just I don't care. Okay, the fastest I've ever seen an equipment deal done is 5 days probably, say 1 week, right? And that's if it's a collateralized, which by the way, a lot of times, these deals require collateral. Not all the time, but let's say, half the time, right? So that being said, is the timing though, is gonna be anywhere from 1 to 6 weeks. Now for some customers, that's not that bad. They're like, yeah, 1 to 6 weeks I can handle, I can wait, no problem. And that's okay. But what about the guy who needs it faster?
Bridge loan.
That's when we need some sort of a bridge product or a short-term product, because those products by their very nature are faster to fund, right? So let's go ahead and briefly talk about some of the negative connotations. We're gonna start with the cons of the short-term product and then get into the pros. So, the pros and the cons, right? So let's go ahead and pass it, right? So with that being said, the short-term products. What do I mean when I say short-term products? I mean short-term lines of credit, anywhere from 6 to 18 months. I'm talking about short-term business loans, anywhere from about 6 to 18 months as well. And then merchant cash advance. Merchant cash advance and short-term business loans basically act as the same thing, but it's just a different legal jargon that
They're the same term?
They're technically, they do mean different things, but they're essentially the same thing. From the perspective of the borrower, they're almost identical.
But I'm saying, as far as how long it runs term.
Yeah. So typically the products are almost identical.
Gotcha.
And a lot of people argue, they'll go, no, merchant cash advance, it's like, dude, it's the same thing.
Wait, what was the other one? Merchant cash?
Merchant cash advance or a loan, a short-term business loan, right?
Bridge loan.
The main difference between the two is a short-term business loan is they have done their legalese, like all their legal documentation is done by using a federal or a state charter bank that allows them to make loans in certain states and be in compliance with those states' lending laws, right? Including usury laws and as well as other types of laws. So with that being said, that's how short-term business loan guys do it. Merchant cash advance guys, they don't try to make loans. What they do is they go, we don't have to pay attention to your lending laws because we're not lending, we're funding. Doesn't that sound ridiculous? But that's not the point. So the point is, they're not lending you, they're funding you. And so because of that, it's actually they're purchasing from you your future revenue. So they're saying, I'll give you 100 grand today in exchange for 130 grand over the next 12 months, right? So it looks very similar to one of the short-term business loans. In fact, the only way you know the difference is by seeing the contracts, because it's almost exactly the same thing. But it is legally it is a different product. And it's good to know this, because some clients will say, well, is this a merchant cash advance or is this a loan? I'll only do one, not the other. It's like, well, sure, they're virtually the same thing, but let's talk about some of the fine, some of the fine data here, what makes them different. What's up, Bill? Cool. All right, so with that being said, let's talk about the cons of the short term, right? The obvious thing, it's going to be, the rate is higher, right? The rate is higher. And a lot of people will assume, oh, the rate's higher, therefore it costs more. That's not true. The cost is the total financial expenditure, the total amount that you paid for it. You go to Walmart and you buy a trinket off the shelf, whatever you paid for it, that's the cost. It's not what it would have cost you in 3 months if it accrued, like it's just a flat cost, right? So the rate is higher here, but the cost is higher here, unless you use it certain ways, certain products, whatever. So that being said, what else is higher on short-term funding?
High payments?
The payment is higher, or as merchant cash advance guys call it, the remittance. So the payment is higher, right? Why is the payment higher?
Shorter term.
Because you're condensing the term, instead of 5 years, 3 years, you're condensing it into 1 year. In fact, interestingly enough, if you condense a 5-year equipment lease into a 12-month term, and you were to take the same total payback and whatever, and you were to condense it, it looks almost identical to one of the short-term business loans. So to a customer, if they can afford the payment, ultimately it doesn't make much of a difference which one they do. But the equipment lease does have a lower payment, so it gives them more breathing room, which increases their monthly cash flow or their operating cash flow. And that's very valuable, right? Because the more operating cash flow you have, the more moves you can make, right? You make strategic moves because you have extra cash in your hand. If that cash is held up in payments, then you're unable to deploy that cash and use it for other stuff. So that is one of the advantages, remember? Lower payment, lower payment, right? So, what are some of the pros of it? It's fast. If you need money in a week or less, and you're complaining about the cost, you're being irrational, right? If you need money in a week or less, then frankly, this isn't an option for you. I don't care what brokers or what smoke they're blowing to you, this is the way to get money fast. This is the only way, right? Unless you get friends and family or whatever, or you work with somebody who's gonna have an extremely high origination fee or a product. For the most part, if you need fast money, if you need money in a week or less, sometimes even 2 weeks or less, this is your only bet. This is it, right? And people will say, well, no, I could probably, it's like, no, you probably can't. Believe me, I've been selling finance for 10 years, man, I know this, like the back of my hand. So, it's fast, right? Honestly, it's fast and easy, right?
Compared to a bank loan, yeah.
Yeah, compared to freaking any loan, basically, if you send 3 months of bank statements, well, nowadays, because of COVID, 6 months of bank statements, remember, we're all collecting 6 months of.
Yeah.
So, basically, if you collect 6 months of bank statements and a 1-page DocuSign application, we could be basically sending contracts out, getting a driver's license and a voided check, and depositing 100 G's in their account. Tell me that's hard. That's easy. Take you 2 days to get 100 grand? Dude, slam dunk, right? So with that being said, it's fast and easy, right? What else is good about it?
Cost less at the end of the day.
Is it will usually cost less. People go, no, it can't. Higher rates. Like, no. If you pay a 1.20, then you're paying 20% one time. People go, 20%, that's crazy. I go, yeah, well, it's better than paying freaking 40% or 35% over here, right? And then even if you try to pay it off early, you're gonna get hit with the front-loaded interest and higher origination fees, and you're paying a higher percentage, higher overall cost on a larger amount. So now you just ate 30 grand of interest instead of, 10.
So with an MCA, there is no incentive though to pay down early? There's absolutely none?
And so every lender and every funder in the short-term business realm kind of has their own playbook, right? Some of them will offer discounts. They'll offer a 20 or 30% discount off of the remaining interest. Some of them will offer like, hey, pay it off early, we'll take your remaining balance and take 7 points off of it. Some of them will straight up give you a principal-only payoff, which is, means you paid off and boom, no more interest that day. Most of our line of credit products work like that. There's a lot of different ways to do it, so I couldn't give you a direct answer to that, but we do have products for all shapes and stripes, right? So with that being said, is it's fast and easy, it costs less, and then honestly, one of the things that kind of gets forgotten about this is this, whether it's a line of credit or a short-term loan, they all almost operate like a line of credit in a way, right? Is it almost acts like a line of credit. You can constantly renew it for more funds, right? As soon as you're halfway paid off, sometimes even less with some of these guys, as soon as you're around halfway paid off, you can typically take more chunks of funding. And usually, with most of our lenders and when we directly lend deals, which is probably about 40% of our deals, is, or now it's probably a little higher, is when we renew a deal, we usually forgive the remaining interest, right, as an incentive for them to come with us. So instead of them borrowing 100 grand and paying back 118, they're halfway through, they renew it, they might only pay 9, 10, 11 grand to borrow that money. 9 to 10% for financing costs, that's a no-brainer, dude. Find it cheaper elsewhere, I dare you.
So if they're halfway through an MCA, has the lender already recouped their investment?
How do you mean?
Well, if we gave an MCA out for 8 months, 4 months later, have you gotten your money back?
No.
No, okay.
But
Then
remember,
I'm kind of surprised that you're willing to re-up them.
Well, no, because what happens is this. Actually, going into the way renewals work and stuff is probably beyond the scope of this conversation. Let's address it tomorrow. Because it's just gonna take a little bit of time to explain. They paid off this much money, so we're gonna kind of top them back off, forgive whatever interest was outstanding, and then put them into a new loan. That's kind of the gist of it, but I'll go into some more detail with you offline.
We've already front-loaded the interest, so there's less interest that we're forgiving.
If it's a loan product,
Okay.
if it's a merchant cash advance
So
product.
it sounds a lot more flowery than it is.
I mean, there's a lot of different ways, right? Is number one is if it's a front-loaded amortizing loan product, then they're halfway through, then they probably paid 2/3 of the interest
Right.
around, right? So you're right. If we forgave the interest for that guy,
Mhm.
they'd save about 1/3 of the interest.
Mhm.
So instead of paying 20%, just for argument's sake, it's an easy number. Instead of 20%, they probably pay around 14% or 13.5%
Gotcha.
cost of capital if they renewed right at that halfway mark.
Mhm.
Does that? I want to pause for a second. Does that make sense to everybody?
Yeah.
Is if the interest is front-loaded, right? If the interest is front-loaded and they paid it off halfway, this is gonna be approximately 1/3, and this will be about 2/3. This is just an estimation. This is not the gospel here. This is just an idea, right? So if they renew it right here, and let's say they borrowed 100K, and they pay back whatever it is, right? So now they want another 50 or 75K from us. They're halfway through. We can actually forgive that, so that way they'll save on their financing costs. So instead of paying, for argument's sake, 18%, they'll only end up paying 12%, because they're paying about 2/3, right? And if you can get alternative financing for 12% one-time cost, not an annualized rate, that's a killer deal. You cannot find it cheaper. So with that being said, is if we were to do that, then what happens is they would put them into a new loan, which will have its own terms. Usually the terms get cheaper and cheaper and better and better as
And
they
it
go.
would include because I see to get them to re-up, you're forgiving the interest on the second half.
But not forgiving the principal.
Right, so the principal is carried over to the new loan product?
Exactly, so let's say, for example, they have this much principal left, let's say they have 60 grand of principal left, for argument's sake, right? So they want another, let's say the first time we give them 100, next time we give them 120, right? Then we'll give them another 60K, right? So we gave them 60 grand the first time, we give them 60 grand the second time, for a new loan of 120K, but they don't receive the whole 120, right? Because we're rolling the 60 grand of principal into it, right? What we call that a renewal. Some people call it a top-up. Technically, those are slightly different, but.
So you give them 60, and then you're gonna collect interest on the 120 over that new term?
Because we already forgave some of the interest, so that's why we're not getting double dipped or double charged.
That's right. So you are gonna get that interest on that first principal, you're just gonna get it in the new loan.
Yeah, exactly, right. But the cool thing is that this first round of financing, they got 100 grand, they were able to use 100 grand, but they only paid 12% for it. Which, if you think about it, they go shop around, they're getting 25, 30% offers all day. gonna pay about
They just
half
have
or
to
a third.
utilize the renewal.
They have to utilize the funding correctly, that's the key, and a lot of customers, unfortunately, there's a lot of people on the East Coast, not to name drop or anything, but, you know, a lot of these East Coast guys, they're very hard-hitting, kind of ruthless call center people, right? So they're gonna tell the customers whatever, right? So, unfortunately, a lot of times the customers, you explain to them, they just don't believe you. So that's where trust and credibility and educating your borrower on how it works all comes into play. That's why I'm teaching you guys this again, because being able to educate your customer on this, how do you think that they're gonna be looking at you if you legitimately train them the right way on how it all works? And the other guy is just like, take my money, which frankly, that's what they do, right? So,
I have a strategic question regarding this because I just found out if you have a certain amount, to buy the loan or to like refinance it, you need to have double that value to, you know, so if you were approved for 120, you paid it down to 60, then theoretically someone else could come in there and offer the 120, so you
This
kind of
is true.
like topping up to avoid that
Competition.
second.
but no, you know, so now you nailed it, right?
Yeah.
Think about it, but then if they go with a competitor,
Then they're-
why are we gonna discount it?
Yeah.
Like, why are we gonna forgive an
Yeah.
amount that we do not have to?
So you're
We're doing
re-upping
it as
it.
an incentive for them to stay with
Yeah,
us.
and when you
And financially, it only makes sense for them to stay with us this way, that's.
so
one of
you
our
like
competitive
suck
advantages.
up that margin of where they could have gone to a competitor because now it's like they need this much more
Even
money.
if the competitor came in with a slightly lower rate, it
Yeah.
would still be financially stupid for them
Yeah.
to switch, because we can forgive it, and we're not gonna forgive it if they go with the competitor.
Yeah.
That would be like me giving a customer a discount to take my future revenue away from them.
Yeah.
It just makes no sense, right?
Yeah.
So with that being said, I didn't need to go too much into this. So let's go ahead and talk about, right now, a lot of our SBA lenders are beginning to, just so you guys know, we do not directly fund the SBA deals, right? We don't have that sort of government guarantee set up, like, we just don't do it, right?
Is that
And
our partner?
Frankly, I don't wanna do it. So we have several different partners that we're using. And with those partners, what we do is we actually have it set up where we can collect a very basic set of documentation. And with that basic set of documentation, we can get a pre-qualification usually within 24 to 48 hours, right? So let's go ahead and talk about that. So before, we used to use a different partner, and unfortunately we're recording, so I can't name drop anybody. But we were using a different partner where we could just send a link to the customer, they can go ahead and fill out the link online, and it automated a lot of stuff, right? And that was a great program, it was simple, but now, you know, unfortunately we can't. So what we have to do now is not much different. We're collecting a very basic submission package. I had Tammy email that to you guys a couple hours ago. It's much simpler than that. Just to be clear, we do not need this full package on every deal. We only need this package on deals that are looking for an SBA or a long-term loan product, right? Just to be clear. And I know that that's not what the email told you, so let's go ahead and just correct that now, right? Is we don't actually need all these documents on every single deal, right? But every single deal that wants a long-term loan product, we do need to collect these, right? So let's talk about what these documents are, right? Very simple. It's gonna be 2 years, 2 years of corporate or business taxes.
Someone saw his mouse pad. Yeah.
So we need 2 years of corporate taxes, we need 2 years of personal taxes, right? What's going on?
No, me and Dom hate each other. No.
Well,
I'm paying attention.
luckily I love you guys enough for each other.
Yeah.
Okay,
This
cool,
guy giggling,
cool,
not me.
cool. What?
Anyways,
Yeah.
that being said,
What,
we also need, in addition to the 2 years of corporate and personal taxes, we also need a business debt schedule. A business debt schedule, which Tammy attached it in the email, is a very simple document. It just lists all the business's debt, their payments on that debt, the estimated interest rate, estimated balance, whatever.
Is that the same thing as a P&L?
No, P&L is a profit and loss statement. That
Okay.
would be considered a financial document.
Okay.
Well, technically, these are all financial
Bad
documents.
question,
but, what's up? Did you have a question too? Okay. So with that being said, is the business debt schedule is just a list of the business's debts. This is gonna include their equipment leases. This is gonna include any SBA loans they have, any mortgages they have for the business specifically. This is gonna include any working capital loans or lines of credit or merchant cash advances that they have. Right? So basically, real simple, all business debt. All business debt goes on the schedule.
If you are a sole proprietor, do you have a corporate tax and a personal tax?
Typically, if you're a sole proprietor or certain types of LLCs, you're going to do all of your taxes, all will be on your personal taxes.
All
I believe it's Schedule C, right? So, with that being said, that's gonna be an LLC or a sole prop. I think now they have like the LLCs acting as corporations. and
Yeah,
stuff
they
like
can
that.
elect
I
to
forget
file
exactly
as an
they do
S
that
corp.
years back. What was that?
They can, if you have an LLC, you can elect to file as an S corp, and you
That's
can do it retroactively in the first year.
Yeah, exactly, right. And then if you do that, you get like an extra $20,000 that you don't have to pay taxes on of owner pay.
There's that, and there's another thing that Trump announced. There's some law where there's like a 10% extra for something. I forget the exact number, but there's something there. Yeah.
Cool. All right, cool. So perfect. So with that being said, is we have 2 years of corporate, 2 years of personal, business debt schedule, and then also an explanation of how COVID affected. Wait a second. Somebody who's a better English major than I am is going to be affected with an A, right?
Yeah.
All right.
But
How
you could
COVID
use
affected
the-
their business, right?
They made them more
So
effective.
just basically a paragraph they would type out?
Just a quick little summary. I mean, basically, it would be, there's no template.
Okay.
We could probably make one. It'd basically just be like, COVID did not affect my business because I produced medical supplies. In fact, it actually helped. It could be something as simple as that.
Should we nudge them in the direction of saying that COVID did affect their business? Would that increase their chances of getting it?
I wouldn't necessarily coach them on exactly what the underwriters are looking for.
Yeah, good question.
Well, no, because remember,
It's
underwriters
coaching.
do care about the story.
Yeah.
And remember what I taught you guys before about offensive versus defensive uses of funds? Right? Offensive meaning you're using the funds to grow, expand, positive, let's go. Defensive using, oh my God, I need help, save me, right? Obviously, underwriters prefer offensive uses of funds, right? But with that being said, I wouldn't necessarily do that, because frankly, I don't know how they're gonna underwrite these deals. I suspect that this is not like the PPP loan, so I suspect that it needs to have not affected their business as much. That's my anticipation, but we'll find out. Just to be clear, guys, the main SBA product that we're gonna be selling is what's called an SBA 7A Express loan. Right?
This is a new one?
This is the same one that we were selling before.
Oh, okay.
So, basically, goes up to $350K with no real assets attached to it, meaning no titled vehicles and no real estate, right? So this is gonna be, you can't technically call it unsecured, but that's kind of what everybody does. So basically what we mean is, you're not putting a lien on their house. You're not putting a lien on their vehicles, but they do put a blanket lien on the business, which is how almost every type of financing you do is gonna do that, except for merchant cash advance. What's up?
Question, sorry, I'm asking a ton of questions, but everybody asks for SBA, so I figured. The $350K, is that contingent at all upon their annual revenue from the year before?
Yeah, it's actually gonna be contingent primarily on their profitability, because how much profit they have
Mhm.
is what sometimes we'll call their excess cash flow. And the gross volume of profit they have is basically the extra money they have that they can use to service the debt or to afford the payment, right? So, if they have enough profit and they clearly can afford the monthly payment, just to be clear, on a $350K, usually it's gonna be around 10 years.
Wait, so we're on a 5-year business, needs to be in business for 5 years, right?
That's right.
A business needs to be in business for 5 years, right?
Actually, I think the new parameters are,
It was 2.
2.
So,
So
it would-
how can you trust someone to make those payments?
Profitability.
Estimation.
well, I mean,
being
if they've
less.
been in
So
business
are we
for
doing
2 years,
profit-
then,
wait,
you know.
Are we doing profit projections?
No. They've been in business for 2 years, we have 2 years of historical financials, what they would call it. And
Okay.
they will underwrite a 10-year loan based off of 2 years time in business. Keep in mind, I see where you're going with this, and they typically will be more conservative on a business with less time in business. In fact, they may outright decline it. That's just the bare minimum.
But they're
That's
taking
okay.
2 years now.
It's kind of like how we'll go down to 500 credit score, right?
I thought it was 5 years.
No, it's 2
They
years.
changed it?
Yes, I don't know if they changed, I don't know what it was in the beginning, but I know for a fact it's 2
2
years.
years and 7%.
So basically, it's gonna be around, it's usually gonna be a 10-year product, it's usually gonna be a 10-year product, 7 to 8% APR, right? I believe, and I'm sure that I'm gonna screw this up, so don't hold me to it, is I think that the monthly payment with these exact terms, I think is something like $42, right? I'm just estimating, I've done a couple of these deals before, I kinda forget which ones are which, but it's around $4 grand a month, right? So with that being said, that's pretty much what we're gonna be selling the most of, right? A lot of clients are gonna jump at the opportunity for this. This is, frankly, it's a good program, you know?
Is it a fixed 350? Like they don't get if they need only 50, they still get the
It can go anywhere from
350.
50 to, I think technically it goes all the way down to 25.
So the
but frankly,
increments,
it's just not worth
the
much time
increments
to do
are
that.
in like 5K amounts, or it's any number that they.
It goes in increments of 5K, I believe. So, I mean, if they wanted a very specific number, I want 3,000.
Like that guy on that call, he's like-
56. They could probably do
Remember that call we listened to, right?
What was that?
Where he was like, "I need $12,300 and whatever .2."
I don't remember that call.
Yeah.
That's-
And then the guy never asked
when
why.
Yeah.
orders come to you like that, that's just a.
It's just like, what?
Like, I know it's important to know what you want, but how do you know it in that granular of
Yeah,
detail?
you psychopath.
That's like the kind of guy that takes apart his toaster, and because he wants to know how it works, he's like, I need 12,367 and 43 cents. Can you do that or not? Like, it's like, wait, just back up, dude. I haven't got your bank statements yet, right?
Send them to
So-
Dom.
So with that being said, what was that?
Send them to Dom.
Anyways, so that being said, is we need an application, obviously, and we need 6 months of bank statements. Frankly, you should be collecting that on every single person anyways, right? Because, you know, we need that. So with that being said, you get an application, 2 years of corporate, 2 years of personal, business debt schedule, which once again indicates all of the business's debt, as well as some of the parameters of it, interest rate, monthly payment, whatever, weekly payment. And how COVID affected their business, just a quick two or three sentence write-up, nothing too crazy. And then 6 months of banks, that will be sufficient for us to secure a pre-approval. Is that everything we need to fund?
No.
It's not. But nevertheless, why are we gonna collect all this package and then get declined, right? I'd rather make it as simple as possible for the customer to apply with us, right? So with that being said, here is what they're looking for, right? They're looking for a credit score above 650. They want a debt service coverage ratio of 1.1 or higher. Let's talk about this. Basically, this means that your free cash flow can afford the payment by a 1-to-1 ratio or higher, right? What we're gonna do is I'm actually gonna send you guys a calculator that helps with this because I'm not gonna try to illustrate all this right now. But with that being said, I'll send you a calculator and we'll do like 8 examples, right? I wish I had the TV right here so I can go ahead and show you guys. With that being said, we'll talk about that later. And these are actually how they describe it. I know it's slightly vague and I apologize. It's strong revenue. I know it's such a subjective statement, right? What is strong revenue? I make $5,000 a month. That's strong, right? No, dude, that's very low. Strong revenue and a profitable business. So keep in mind, the tax returns are going to indicate whether the business showed a net profit or a net loss. Sometimes those net losses are artificial. For example, your business might have made $100,000 of profit last year on $1 million of revenue, about a 10% margin, but you might have had a bunch of equipment, and for tax purposes, the government wants to incentivize businesses like us, like all businesses, to purchase things in the United States, right? To purchase more equipment, to invest in their businesses. That stimulates the economy, right? So what they'll do is if you buy equipment and the value of that equipment depreciates or lowers, if the equipment's value goes down, they actually allow you to write that off on your taxes. You don't pay taxes on that amount. So you buy a $100,000 tractor, and after 2 years it's worth $50,000, that means that net profit of $100,000 that you were gonna pay taxes on, now you can put $50,000 of net profit.
That's accelerating the depreciation? or-
So accelerating the depreciation means to take the depreciation, which should normally be over 5 years, or 10 years, or 30 years, or whatever the term of the loan is, or lease. Actually, I'm sorry, you can't depreciate lease. But with that being said, you could, so let's say it has a 5-year term, and you're depreciating it little by little, year over year. In some situations, and I'm not an accountant, so I'm not gonna be able to give you much detail on how we do this, but sometimes you can accelerate the depreciation. So instead of taking that tax benefit over 5 years, you can do it in like a year or 2. That's called accelerating the depreciation. Frankly, we're not their accountant. You might wanna mention to them, yeah, some of our clients will accelerate the depreciation to minimize their tax liability. Talk to your accountant, sir, but I recommend to move forward with our loans that we can take advantage of that, right? So, this is basically what they're looking for. I'm not gonna give you, they do have some other guidelines. It's a little bit, too much for the purpose of just a first or second call, right, with the customer. But really just gather these docs, make sure they have a 650 credit score, and make sure they have a profitable business. If they do, you can probably stand a strong chance of getting them approved for our SBA 7A Express loan. The Express loan takes anywhere between, the fastest one we did, fastest I've ever even heard of.
10 days.
We did it in 7 business days. It's nuts. Is that ever gonna happen again? Probably not. It was actually, I'm flabbergasted how quickly we got it done. It was a small one, it was like 200K. But with that being said,
Small.
well, small for an SBA. So, so with that being said, I would say anywhere between 2 weeks to 8 weeks. 8 weeks would be extremely long, abnormally long. 2 weeks would be extremely fast, abnormally fast. I would say probably the real average, let's say 4 to 6 weeks. But this is the actual range. It'll probably be within 4 to 6 weeks though, right? Cool. So with that being said, what I would like for everybody to do when you're talking to your clients, remember we have that list of products, is make sure that you don't neglect this product. This product is very appealing for most customers. They like to see it. Mostly because they assume low interest rate means low cost. Remember we talked earlier? So that's usually why they like this product, because this is what they commonly associate with good financing. But it is a good way to lead in because most customers are interested in it. And then over time, then we can actually show them all the other products, kind of put it on a platter and let them pick what they want. Did you have a question, brother?
Yeah, that's what.
Good, cool. All right, cool. With that being said, guys, that's it. Does anybody have any questions, comments, concerns?
Tell me again what the DSCR stood for?
The debt service coverage ratio. I'm gonna send a calculator on it shortly because I'll get into it. Anybody else?
I have a question, not necessarily with this, but just sales strategy.
Yeah.
Okay? When you go through, a lot of the information that we gave here to a customer and they're not getting it, what would your advice be when they say, that's just too high, I can get it for less at XYZ or local bank, whatever? I hear that a lot and I feel like they're not even really listening to all the details I've broken down. It might be my bad for not explaining it well enough, but I have heard that a lot. Like, yeah, there's just no way I'm gonna pay da-da-da or in that ballpark.
So what I like to do in that situation is, yes, there are many situations where they're gonna have a line of credit at the bank at 5%, they have $100,000 sitting in it, and they could draw on it at any time. Let's be honest, that's not our customer.
Yeah.
So,
We ain't competing with Bank of America,
Yeah,
and now on
we're not
equipment,
competing
stuff
with
like that, we can. Equipment financing, whatever, we can fight head to head and tooth with them, right? But, or toe to toe with them. But with that being said, yeah, if they have a line of credit access for them, or if they don't need money for 2 months.
Yeah.
It might not be our ideal customer.
loose.
If you hit them with this,
Mm-hmm.
and they're still like, this is way too high, this is crazy, then one of two things. Number one, they're completely irrational or ignorant of the market, which the majority of the time that's the case.
Mhm.
Not to be mean to our customers, but the most time they're not finance guys, they just know what they see on TV and stuff.
Right.
Or two, they need a little bit of nudging education. So what I would probably do would be, I would explain to them the difference between rate and cost.
Yeah.
That's actually what I like to do to handle when I get objections. I like to use it as an opportunity to educate them. Because now, instead of them looking down at you and attacking you, they're looking up to you because now you're actually giving them legitimate, good information. So for example, they go, well, I mean, I'm not gonna pay more than 7 or 8%, and you go, well, Mr. Borrower, if you want just a low interest rate, we have lower interest rate products. That's not a problem. But if the cost is what you're trying to reduce, then perhaps short-term financing could be something to look at as well. It really depends what you're trying to accomplish. Now, are you more concerned with the rate or the overall cost of the financing? Because those are two different concepts, sir.
Okay.
If you hit them like that, first of all, it's gonna usually put them off guard.
Yeah.
Usually they're gonna go, oh, well, and then.
Usually
a lot of times they're not
the
gonna
rate is
say-
my cost, so.
Yeah,
they
the rate
usually
is
say-
the cost,
yeah,
and
yeah,
then you're like, no, the rate is a
Yeah.
function of the cost.
Yeah.
They're functions of each other, but they're not, it's not the cost. Cool. So what I would probably do is, frankly, I'd go, well, research, if you can go to the bank and get 4 or 5% money right now, and you don't need it fast, then I would probably do that. But what I would recommend, if you're looking into alternative financiers, is we can offer you a low rate, long-term product. But even with a low rate over long term, if you take and I like to give them the mortgage example. If you take a mortgage at 4% over 30 years, people think, oh great, I got a 4% loan. You borrow $500,000 to buy a house. At the end of that loan, you've paid $500,000 of interest. So your cost was 100%. You paid 100% more than the principal, right? So if you want, sir, we can put you into a program like that, or we can put you into a shorter term program. It might cost you something similar like a credit card, but if you pay it off quickly, use it properly, overall it'll cost you significantly less. Frankly, sir, I make commission on either one, so I don't really care what you go with. What do you think you would prefer? That could be a cool way to approach it.
Okay.
You know, and if they're still like, then you're like 2 years on.
Yeah, I get it.
Right?
Cool, thanks.
Anybody else have any situations like that?
What would the minimum revenue be? Is there?
I actually don't have that here. I'll confirm that with you. I think it's either 150 or 250. But usually if they're at the minimum revenue, frankly, it's gonna be a really small deal. That doesn't mean don't give them the time and care and deserve. It just means kind of. I would aim for at least minimum $250,000 to $500,000 a year for minimum revenue for this product.
One more quick question for you. When people do ask about the SBA, should we just auto pitch we can get you approved up to 350?
Yeah, our SBA Express program goes to 350,000.
Okay.
It takes between 4 to 6 weeks. If you send me this documentation, I can knock this out for you right away. If you need some money to hold you over in the meantime.
Yeah, I remember we used to do that.
Yeah, if
we
you
did
need
the
some
roll.
money to hold you over in the meantime, then we can possibly work on a multiple step type of program.
Alright, cool.
Right? Keep in mind that is treading a little bit dangerous waters because we don't want to mislead the customer.
Yeah.
So,
Alright.
cool. All right, cool.
Cool.